Ladies and gentlemen of the crypto space, we're live on a Monday, April 14th at 11:58 a.m. about noontime here on the East Coast. Yay. Got a half a day's work done. Oh, gotta crack my back every now and then. You stand up and walk around. So, morning was off to a nice start because I stepped outside, took a little bit of sun, did some work at the office, and the markets look basically the way they looked on Friday. Um, Not too much exciting, not too many exciting things to talk about today, but things look interesting. We've been waiting years for this particular setup. Now, obviously, this situation or the current status of everything has the macroeconomic backdrop, which certainly should have everyone worried to a degree. There is very reasonable conclusions and thoughts circulating about the stability of the economic order. Now, it's not a bad thing for things to change, but it's destabilizing. And what does destabilizing mean? It basically causes a shit ton of volatility. Now, I don't think we're on the road to Mad Max. I don't think Immortan Joe is going to be on the ballot, but I think things will change significantly in the mid to long term. In the short term, my general sentiment is you'll get a bit of a hybrid of a can kick. And what they often say in finance is change starts at the margins. So you're going to get the can kick and a little bit of change starting at the margins. Now, obviously, all the narratives that are going on with regard to tariffs don't leave everyone with a lot of confidence or a lot of conviction on, oh, this is what's going on. This is what's playing out. For better or for worse, everything in existence is dynamic, meaning, strong beliefs loosely held. You could want to do something. It could be a desire to have a strong administrative policy, but you need to adapt to the realities of daily conditions. So I don't expect consistency in anything. I That's the last thing that I would expect. And the reality is, even for our individual selves, we should be changing over time. We should be evolving. If you are telling the same story you told 10 years ago, okay, fine, maybe at the core, but around the periphery, things should be updated because there's always something new. There's something new in the status quo. The system has changed. You have changed. So, how can we expect one single story? They are going to put on tariffs and not take them off until they capitulate. They being anyone else. So the point is, I'm not surprised. Not much surprises me nowadays, and that leaves me comfortable because I expect this volatility. I expect this uncertainty. I expect no one to really understand what the fuck is going on. And that introduces volatility into the markets unto itself because everyone's flip flopping. Is the system going to crash? Oh, a crash. What is a crash? I'm not going to restate something I state all too often, but is it going to crash? Is what going to crash? When someone says there's going to be a crash, ask them, what is going to crash? What the fuck is going to crash? What does that even mean? It's going to crash. Inflation is high. These are, what's a crash? Is what, an adverb? It's describing an action. Yeah. And inflation is a state. I don't know. It's not a noun. It's an adverb as well. It's describing economics, plural. So these are descriptions of markets specifically. Even if you're talking about consumer staples and consumables in grocery stores and whatnot. Still a market, whether you're buying on a market of boom or meme coin stocks or cryptos, or you walk into a supermarket, literally, they're all by definition markets. So don't get lost in the noise of Gen Pop, the general population that has an incapacity to describe what a crash is, or what inflation is, or these headlines that they scream flip flop. Meanwhile, the reality of existence is everything is dynamic and everything is constantly changing. So, how can we expect it to be static? Tariffs are on, tariffs are off. That's not the way things work. So it's all fucking noise. You know it's not noise? Waiting 3+ years for the damn DXY to come below 100. That's not noise. This is what we wanted to see. This is what we were expecting at some point. And the expectation was always reasonable because the nature of existence is cyclicality. What goes up comes down. What goes down comes up. The dollar going down doesn't cause the dollar to fail, ladies and gentlemen. That's just not the mechanics of the system. Anyone that says the contrary does not understand the way the system is constructed. And the system is the world in which we exist, where we spend, where we swipe credit cards, where you go to an ATM, where you go to a teller. Who the fuck goes to a teller inside of a bank and takes actual physical cash from a teller? Nobody does that. I find if you go into an ATM, you're getting physical cash as well. The vast majority of people are using electronic forms of payments. You automatically pay your credit card from your bank account. You automatically pay with ACHs and wire transfers where you're swiping your damn credit card. It's an electronic payment. Where the hell did those dollars come from? Can't answer that. That is something to understand. Because when you understand the mechanics of the system, you understand that the dollar doesn't fail by going down. Arguably $300 trillion on the planet. I r Look, I'm always forced to digress to expose the reality, the signal through the noise. The United States government has printed a total of $5.6 trillion. There's 300 trillion or more dollars in circulation around the world. Yet the US government has only printed 5.6 of them. That's a great that's like, what does that even mean? So anyone who says that the dollar going down is how the dollar fails doesn't get this. This doesn't get it. The United States doesn't hasn't printed the vast majority of dollars. What? So that's the biggest eye opener that I ever had. And I've been a lot of what I think is framed on that reality. Okay. Who printed the dollars? They have a printing press? Is that fraud? Is that is that a counterfeit? No, no. Guess what? When Europe prints dollars or Asia prints dollars or what have you, we use those dollars in the US. The Federal Reserve, the Treasury accepts those dollars for payment to purchase treasuries. They're in our banks. Dollars printed in Asia, dollars printed in Europe are used in our banks? What? So we've been telling this story for so many years, it just comes second nature. And I guess it is good to digress on these types of statements every now and then to remind folks of the long path we've been on, the path of understanding the way this whole shit system works that gives us comfort because it does make sense. The dollar will go down cyclically. The dollar will eventually go very up. cyclically. So cyclicality is a short duration of time, relatively short, probably a couple of years. Secularity is talking in terms of like 2008 to 2022, or 2000 to 2008, or 1971 to, I don't know, the 90s or whatever, late 80s. And frankly, you could look at the cyclicality and the secularity on merely the DXY. And as I always remind folks, you could get more granular and look at all the cross currency pairs, but then you got more information to deal with. And that's not good for anyone. Too much information is not good for anyone. You want the least amount of information to understand the most possible. Because that, my friends, is called efficiency. We only have so much time in the day, and there's no reason to burden yourself with excess information. You want to understand the gist. You want to understand high level what the fuck is going on so you can maintain sanity through all this noise. Literally, so all these thoughts thus far are merely because the dollar is below 100. The DXY is below 100. And the DXY isn't really the dollar index, mostly euro and yen, a little bit of Swiss currency in there as well. But the point is, it's been years in the making. Check it out. Maybe this is the point of today's stream because it's a little bit of a lackluster day. Curve looks good. Bitcoin looks good. Ethereum has been gutted until we get some serious monetary expansion. Then Ethereum just outperforms. And frankly, everything will outperform Bitcoin. That's just the way it works. But you need the currency expansion, which allows for the monetization of fintech, financial technologies, which is basically banking products. In the traditional world, that was called securitization, which is derivatives. But we have other shit in crypto other than derivatives. We have literally replacement banking products. So that kind of changes the game. Once the monetization occurs, it'll be different in many regards. The same, but different because there's new products, new businesses to be monetized. So that obviously is different. So what's not different? All right, you get capital destruction, you get currency destruction, you get deflation. All right, so you get global currency supply increase. You're going to probably have inflation blow out outside the U.S. first. That's my 2 cents. The Fed has decent control over domestic currency supply. Outside the world bleeds over because of all the investments that go into the markets, U.S. equities. But credit is pretty tight. Who the hell is borrowing on a mortgage? So that's what interest rates do. People think, oh, the Fed's going to cut rates. The Fed's going to raise rates. And that's such a popular narrative. When is the Fed going to cut interest rates or do QE? And it's all these popular narratives. What is an interest rate? Short-term interest rates allow the banks to lend between one another. The Fed funds rate allow the banks to lend. So what does that do? That loosens credit. Okay, so obviously with interest rates at what 4.4% right about now, what do you got? 6.5% mortgages? What are credit card interest rates? How much debt is there? Debt to equity? All right, in residential real estate, debt to equity is pretty good. Much better than 2008. Much better than Canada and Australia, as we've seen in some data. But the point is, when interest rates are higher, credit slows down. And that's basically the domestic way that money's created. When you swipe a credit card, you're printing dollars. That's an important thing to understand. When you're borrowing on a mortgage, you're printing dollars. Those dollars didn't exist. When you get a home equity line of credit, those are dollars being printed. So, okay, great. When this happens around the world, that's dollars being printed as well. And that's, my friends, how the vast majorities of dollars have been printed. So I don't know what the hell was my point there. So the Fed has pretty decent control over domestic currency expansion. Clearly, if you see them cut like 1%, 2% dramatically, you're trying to front run some sort of deflationary episode, yeah, it's going to get weird. But if they cut like a half a percent, responding to a deflationary impulse that's already in effect and occurring, that tends to stoke fear because of the psychology of it. Oh, the Fed's reaction function, they're afraid. And that just accelerates the depreciation. FUD spreads virally. But if they do it proactively, we could actually see interest rate cuts be bullish. Boomer meme coins. Will they be proactive? I highly doubt that. Historically, they're reactionary. But the point is, it's irrelevant. That's not what causes the big expansion. They've done well at stabilizing domestic economic conditions now. Look, inflation has come down significantly. If you think that's caused by tariffs, no, it's caused by psychology. It's caused by the combination of economic factors and the policies and toolkits, the tools that the Fed uses. It's a combination of everything. And what the announcement of tariffs does is it jumpstarts the psychology and gets people like, oh, gets people worked up. Like, oh, what's going on? Shit's changing. And when shit's changing, it's a very simple psychology. That's volatility. And what do you do when shit's volatile? You're like, maybe I should stop spending as much as I've been spending. Ooh, maybe the market's going to crash. Maybe I need to save up some money just in case. So that's the psychology happens quick. And even like Fed tools and the administration's policy, it has direct effects, but the vast majority of the effect is the psychological reaction to the announcement of the damn tools being used. Everyone gets themselves worked up. The most important takeaway, and I stand by this, is it's not a capital management methodology. It's not even something to consider from a monetary perspective. It's just basic psychology. You could only control, or you could only, all that matters is what you can control, your domain, what is in your influence. Now, the first and foremost thing that most people cannot control is themselves. Emotions are very powerful. Emotions have no business in capital management. How the hell, as a human being, do you live with emotions and yet separate them out from this behavior we engage in of capital management? Not so easy. It's more of like a psychological puzzle or a question that everyone really needs to ask themselves and not just brush it off like, oh, what is this Looney Tunes guy thinking? It's real stuff. And in the end, everyone will come to their own conclusions about a methodology, maybe, of how they think about things. And I think this process gets easier as you get older. It's very hard when you're young. Emotions are overwhelming, but can't hurt to start. Can't hurt to think about things a little differently. I realize that most of what we're overwhelmed with throughout the day is bullshit because you have no control over it. If you have no control over it, there's nothing to think about, period. Now, it's important to understand what's going on, but you can only act and make decisions based on the things you're in control over. So don't worry about the things that you're not in control over. And this is all really the foundation for rule 1 through 3. Notice that I really haven't come up with rule 4, although I do have several repeating rule number ones. But the primary rule 1 through 3, that's pretty static actually. That's the culmination of a lot of years, a lot of growing up. These streams have been very different over the years. If folks remember some of my original content, which is still online, but it's basically useless. These more recent streams dealing with psychological and philosophical phenomena are much more useful and meaningful. Time is both our biggest ally and our biggest friend. It's our enemy, our biggest ally and our biggest enemy. The biggest enemy because we only have so much time, and our biggest friend because in theory it does all the work as long as you have the proper psychology, how to engage with these crypto markets. So many folks. I find it so fascinating when I talk to folks about investing, and that's not you guys. I'm, like Gen Pop or friends at the office or friends wherever, talking to some folks in the sauna or whatnot. They're like, "How?" It's the opposite for myself. I am infinitely more comfortable allocating capital to these crypto markets than boomer meme coins, and that is just bewildering to folks. Bewildering. They just don't see it. They don't understand it. It's been a long time doing this crypto stuff. Very long time. I mean, shit, we've been doing this stream for 4 years, but we've been, I remember so many interesting things over the last decade that have played out. So much insanity, so much fear, uncertainty, and doubt. And if I did less freaking work, did less, and if I only realized some of my rules earlier, it would have been that much better because time does the work. And most of my rules came online probably in late 2021, 2022, sometime, that time period. So it's been about three and change years of this really serious, down to earth, calm, cool, collected signal, no more bullshit noise. Rule number one, own more assets. Simple. Okay. That implies you want to buy them at a reasonable price. It also implies you have a certain amount of capital. You make a salary. You can't spend all your money. So maybe the most important thing, just for rule number one, is to get financial books in order and understand how to balance a budget. And this is probably an impossible task for youngsters, but it's one of the most important things people do, or can do, or should do. Never spend more than you make. Frankly, I guess my dad taught me that. May he rest in peace. Never really said it, but he implied it. I learned a lot from my father. A lot in hindsight. I didn't know it at the time. My work ethic comes from my father. I number one rule. See, here's another number one rule. Always finish what you start. Number one rule. You want it done right, do it yourself. Number one rule. Do what other people don't do. And that doesn't mean like do the opposite of the decisions. Do the things that other people are afraid to do. Like or just they don't have the courage. They feel it's impossible. And they're like, oh my, I have to pay someone else. Do the things other people don't do. If you're not different, you're the same as everyone else. And unfortunately, the worst part of capital management or money or investing is that the few will always have the most money and the majority will not. Now, obviously, the disparity has gotten to a bit of an extreme, and that's going to destabilize our populations globally. It's not just the U.S. problem. That's a part of the problem. It's a part of the equation to consider. And you could always come back to like education, but ultimately the truth is it always comes back to parenting. So that's something I take great pride in. Everything I say and everything I do nowadays, I think about my kids. How would I teach them? How would I help them understand these types of things? Anyway, I'm sure that's going to be a big challenge as they get into their later teenage years. Whatever, I'm prepared for it. Don't spend more than you make. It's a simple rule. But look, what Justin Hammer and all those other folks that eat that blast people over their horrible economic decisions. but that's the majority. What does that mean? I don't know. I don't want to go too far off philosophically because then it starts to get political, like nanny state type shit. What responsibility does the state have to ensure people don't fuck up their lives? It's not even a political question, it's a philosophical question. Or maybe it's a philosophical political question. The philosophics of politics. People need to be responsible for themselves. So take responsibility for yourself. Don't spend more than you make and do what others don't do and invest and own more assets and cyclically stop buying assets. Maybe inflation is high and you don't have as much free purchasing power. And that's what I define as a period of austerity. If you're making relatively less money or relatively less purchasing power, if you understand what I'm saying, then you could buy less things. And then buying things. When you buy things, it's like going into a supermarket and you're buying things, or when you go to Coinbase and you're buying things, or when you're going to Fidelity and you're buying things. Buying things is buying things, whether it's a fucking stock or crypto or some shit at the supermarket. Things. Don't don't separate these things. This is all one idea. The concept of a purchase, all the same stuff. You have a currency unit, you can make a purchase. The difference is you go to a supermarket, you eat your purchase. You go to a crypto, you're not eating your crypto, but hopefully your crypto says rule number three, fuck you, pay me. You make a purchase of a place to live, you're living in the damn home, you're not eating it. So, okay, so what you purchase has different characteristics, but purchase is a purchase. And if you're buying something, you're buying something, you're buying something. It's kind of like what I say 5% is 5% is 5%. Doesn't matter what the investment is as long as it's paying 5%. And obviously, you want to do your due diligence because you want to make sure XYZ. How much does it cost? How much is it paying? And how likely is it to continue to pay? Now, if you go into the supermarket and buy some canned soup, how much does it cost? Check. How much is it paying? Ain't paying you jack shit and probably going to cause some indigestion. And it's not likely to continue to pay you. So XYZ is not very meaningful with regard to going to a supermarket for those types of purchases. XYZ is pretty shitty as well if you go to the stock market because you're at the whim of a board of executives to give you your peasant dividend after they take their fat corporate salaries and bonuses. Then you have the crypto space where it's not up to a board, it's programmed. And that's what's different this time. And to me, that's the most extraordinary thing I've ever heard in my entire life. With software, fine. What did Iron Man? What was it? Iron Man 3. We got to fix human resources. You got to get the humans out of human resources. Happy said that. Get the humans out of human resources. So this brings us back full circle straight into what's going on with AI and robotics. Humans are a burden. We are our own burden. We are difficult to deal with. We're emotional. We're inconsistent. Even though we can be reliable, we're frequently unreliable. So you want predictability, you want consistency. You don't necessarily do it with consciousness. You do it with intelligence, though, and you do it with software and robotics. And that'll be predictable. That'll be consistent, very reliable. So what's the most exciting thing about cryptoism? Predictable, consistent, reliable payments. Oh shit. That changes the equation. That's different this time. Now, obviously, what's the reality? Business is a business is a business, whether it's a pizza shop down the block or some corporation giving you a 5% dividend, realty income corporation or crypto, but they're all the same with regard to when business is bad, maybe you make less money. When business is good, maybe you make more money. So you're choosing between different things to purchase. And when times are good, they pay you more. When times are bad, they pay you less. How much does the can of soup pay? or this other stuff you buy at the supermarket. It pays you nothing. It's a consumable. I don't know. Just trying to remind you that a purchase in the supermarket, a purchase in equities, and a purchase in crypto, a purchase is a purchase is a purchase, whether it's a home as well. So which ones pay you? Now that's a freaking interesting purchase. Now that's a purchase I want to purchase more of. Me, I'm in rule number 2, so I'm not purchasing anything right now. But why don't they teach this shit in school? Ooh, 401ks and IRA. Oh, dare they talk about IRAs, retirement. One day, young man, you won't have to work, and the young kids will pay for your old ass to not work. Can you believe that an entire generation grew up on that shit? One day you won't have to work anymore, and you could sit at home bored as fuck out of your mind at 65 years old playing Call of Duty. Fuck. It's a great philosophical question. What the fuck is retirement? What the hell is retirement? It's unacceptable. Unacceptable. But bear in mind that's a Gen Pop narrative, the concept of not working. What people really want is optionality, freedom of choice. They want to be able to work the things they want to do when they want to do them. That's what people want. Retirement is a one-way ticket to mental decay. That's your downhill. I remember my grandpa. He's long gone and lived to 99, 99 freaking years old, and he went to work all the way into his 90s, as in like taxi to the train station to New York City every day. Now that's work ethic. That man kept busy, but the second he stopped working, that was it. Especially in your 90s, because if you stop working and you allow your body to decay, whether it's physically or mentally, it happens quick. I mean, shit, it happens quick post 40s if you don't keep up with your physical stature and your mental acuity. So anyway, that's a digression. So 10-year down at 442. I want to see this come down, but the problem is it's been volatile as hell. And look at the move indicator up at 137. So move is the volatility indicator for literally 10 to 30 years, amongst other things. But it's basically long duration US debt volatility, where the interest rate and goes up and down, up and down. So when you have volatile US long-term debt, that kind of shocks the system, and it's like, oh, we're not going to print dollars. And I'm not talking about the US printing dollars. I'm talking about the rest of the world. So what we want, as we've been saying for some years, is finally for the dollar to roll over, move indicator to roll over, and clearly that didn't happen. It's not happening right now. And the 10-year to come down in interest rates. Let's see this thing come down to 3.5. So everything else is noise. Oh, the rest of the world is going to sell their U.S. debt and drive interest rates through the roof. You watch the data. I watched 3 charts out of the day, and I'm like, all right, here's my update. I can tell you what's going on in the world based on these 3 charts. If I have a general understanding of current headlines, like, oh, all right, now that we know the tariffs are in play, all right, so if the move indicator rockets to 180, all right, someone around the world dumped a shitload of US debt or got liquidated and the dollar spiked to 101 in 2 hours. So something's blowing up. And I can tell you that just by looking at those 3 charts. Or if the DXY falls over the next 3 months, quarter of a year, to 95, 93, 90 or lower, and move rolls over to back to 100, 90, 80, 70, and the 10-year rolls over to 3.5, 4 to 3.5. Guess what? What does that tell you? Things are calm. And what do we know about nature? What is calm will not stay calm for a long time. It shall be cyclical. So things are volatile. The volatility comes down, and then things get calm, and then the volatility goes up, and things get volatile again. So welcome to the real world. And whether you look at the headlines or not, that's the way it's going to play out. Cycles will cycle, but those cycles may be a little bit different this time. Now, I didn't grow up financially aware between 2000 and 2008. I was in college at the time, and I was naive as all hell, thinking I could be an entrepreneur. Anyway, that didn't work out. But the point is the move indicator. If you look at the DXY on the 6 month chart, this tells me the roadmap. Dollar's too strong came down significantly after this massive, massive shooting star, which took 2 years, well, more, probably, let's say 2.5 years, considering a part of the shooting star. Took 2.5 years for this dollar to finally come down. And that's the world telling you the dollar needs to be cheaper. Otherwise, the party doesn't keep going, doesn't work very well. So over the next 10 to 15 years, dollar comes down, gets down to 60 something. And that just entrenches the dollar further because nobody pays off their debt. Nobody. Fine, maybe if you're lucky, you pay off your credit card debt because you're smart and you spend less than you make. But you think the countries pay off their debt or the big corporations? You think the cruise companies, where it's a $500 million for a cruise liner, pays off their debt? No, they pay the interest expense. Maybe they bring down the principal a little bit such that when they are end of life the ship, they're able to liquidate it for scrap metal and cover the remainder of the principal, considering the appreciation, the nominal appreciation of price of the scrap metal. That would make sense because then over like a 25-year lifespan of a cruise ship, you rake in 200 mil uh, in profit, and you drop the principal down on the $500 million loan to, let's say, 350, and then you sell the scrap metal for nominally inflated price of 350. You paid off a little bit of principal, and maybe it's even dirtier than that. Maybe you just keep rolling it over until the scrap metal pays off the full 500 mil, and then you just collected 200 mil over like 30-year lifespan, and you never paid the principal really. You just let the nominal inflation of the metal itself just do what it does. It's gross. That's probably the number one thing that's the noise. And that's what everyone focuses on, especially very much in the Bitcoin community, the noise. It's gross, it's disgusting. It's economic shit. The printing of currency, the concept of credit, malinvestment, the debt. It's disgusting. But they get stuck on that instead of going on to the second, third, fourth, fifth order and like, all right, this is what they're doing. This is what it causes. This is potentially how things play out. This is the nature of the financial construct system. This is where I fit into the system and make it make sense for you. What can you do? Can't control shit of any of those equations. So the best that you can do is understand them and attempt to position yourself, and that's where the train analogy comes in, ladies and gentlemen. Like it's and basically the train analogy is a roulette analogy, just a little bit more certain than roulette. You know. Well, then again, it's not because if you put um, chips on 30% of the wheel, you have an X amount of percent chance of catching a bid or winning. So if you invest in 10 assets, all right, you got a good chance that at least some of them are going to be very successful, and all you need is one of them to be really successful. So the train analogy is a roulette analogy, and it's all a degree of a gambling analogy, but you're able to skew the odds in your favor by because of percentages. If there's you understand the way the system is heading, you're like, all right, things are going to get more financialized. Why? Because that is a dependency for the entire system to continue to exist. Yes, it's gross. So what facilitates financialization? And then you can literally draw on a little bit of headlines like, oh shit, this will help them sell treasuries. The administration said that they want stable coins to be used to further entrench the dollar and global economics. And then everyone gets lost in the fucking reserve currency thing, which drives me nuts. Gives a shit what people are saving, and sure, that changes the nature of economics and the rules based order, as they call it. But who cares about the reserve currency? Because what you have is the debt servicing currency, which means you're good to go. You understand? There's X amount of dollars the world needs per year to just pay the interest on their debt. And as Brent Johnson points out, where was it? I'm not going to go with it. He points it out very nicely. So if the dollars you need to pay back your debt, I'm not talking about your damn credit card bill. I'm talking about hundreds of billions and trillions of dollars around the world. That money was printed by taking on debt. If you pay back your debt and they pay back their debt, they pay back their debt, there's less and less dollars, which means the death of the dollar can be observed in technical form by it going straight vertical to the upside. Because there'll be less and less and less and less dollars. Very simple. It's one of few people that once you understand what he's talking about, it's really simple, and it's like, oh, that makes sense. Makes perfect sense. All right. Anywho, dial it down over the next 10 to 15 years. So much for a Monday talk. There's your next 15 years. See you in 15 years, ladies and gentlemen. Um, Bertrand, hello. I managed to come by and chat. Welcome. I obviously went on my shit. Was that? No, that was about a 40-minute monologue. But I hope it was interesting or useful or informative or calming. The most important thing I hope people get from me is calming. There's nothing to be anxious about. Nothing to be. Everything to be calm about. That's how you win at capital management. Letting time pass. Welcome. Morris, this time seems so inconclusive. Inflation is trending down, unemployment also, dollar also. What to make of it? Oh, inflation. Well, people are broke, and you have your disparity. The wealthy don't give a crap about 20, 30% inflation. General public do. It's going to slow things down. Disparity is going to increase over the coming years. Unemployment, I don't know what'll play out with unemployment. Listen, you're not in control over other people's choices and decisions. Everyone should be educated. I think that's important, but nowadays it's different because you don't necessarily need an institutional education to be educated. Even back in the day, that's public libraries changed the world, and people had a capacity to self-educate. Very smart people out there that didn't have necessarily an institutional education. So these are very important things. So that plays into employment. And this comes back full circle to parenting and what you're taught. And I tell my kids two things, well, any endless things. I tell them I'm proud of them every day. I drop them off at school every day, and I say, "Is that what I say?" I say, "I'm proud of you." Not easy. So it's okay to not like school, but one of the biggest lessons in life is you do things. There's people that do, and there's people that don't do. And, not to knock on it, I played a fair bit of Xbox in my day. I was very good at knifing people in Call of Duty, but that's not doing. That's not being productive. And then there's people that do, and there's people that don't do. Ultimately, you could talk. People could get so stereotypical about culture and ethnicity and just group people in the most awkward ways. But in the end, there's one stereotype that is real, and that's there's a couple, but I'll say two of them without getting too controversial. There's people that do, and then people that don't do. And what does do mean? Do means like, all right, I choose to finish high school. I choose to work every day. I choose to not spend more than I make, not bite off more than I can chew, have a balanced budget, be financially responsible. I choose to go to community college because I can't afford an institutional college or a higher level college. I choose to get straight A's and I choose to attempt to get a scholarship. All right, I didn't get a scholarship, and then maybe I take another course at community. I keep going to school. I'm not saying my path, I'm just saying an example of do and don't do. Then there's people that don't fucking stop. They keep going like they're on a damn mission to do versus don't do, not do. And then the other stereotype that is real, and this isn't like it's not derogatory, it's not it's not stereotypical necessarily in a bad way. It's real. There's rational and irrational. People that don't make sense. People that don't justify opinions and positions, facts. And that doesn't mean it's the same ideas as yours. I might believe certain things from a political standpoint, and other people might have different opinions, but they could be rational about it. Rational. I told my wife a long time ago, it's about arguing, it's about fighting. And anytime a person's voice elevates, it's a manifestation of an incapacity to articulate what you're thinking. Try and digest that one. That's an interesting one. Because if you had a capacity to say what you were thinking, you'd realize, if you were rational, that saying it louder doesn't work, doesn't produce the outcome, the desirable outcome. It's counterproductive. It's inflammatory. So it's the wrong choice. So any time you ever hear someone yell, the lack of capacity to articulate. Now, listen, don't, I'm not judging. It happens to me. I yell and I'm like, shit, damn it. Well, it's not easy. It's a human condition, right? Anyway, so literally, I digressed on all this shit because of unemployment and do, don't do, rational, irrational. That's the only difference between people. Otherwise, everyone's identical. It's truth. What to make of it? Don't think too much about it. It sounds like you're thinking of a lot of noise, Morris. Don't think of the noise. Think of the signal. Dollar comes down over the next 10 to 15 years. Eventually move or roll over because it cyclically does. Eventually the bond market rolls over because it cyclically does. I mean, if you look at the 6 month and the 10 year, we literally have spent the last 2 years stopped out at the 50, the 200 on the 6 month chart. I don't see this going through. I see this cycling down. Look at this 10 SMA, 50 SMA cross. That's absolutely insane. So fine, you break down to where? About three and change. All right, great. And that'd be a 50 SMA mean regression on the 6 month chart. 6 months. So let's say over the next 2 years, maybe. Long term trends. My general expectation dollar down, move collapse, 10-year yields, 10 to 30-year yields down cyclically. And then they spike up again. I generally expect higher lows and higher highs on interest rates. I expect lower lows and lower highs on the DXY over the next 5, 10, 15 years. And that sets my mood, that sets my tone, that sets everything about what I understand of economics. That's my entire capital management thesis and why I do what I do. Hope that helps, Boris. Arrow, good afternoon, my friend. Hope everything's well. Peter P, good morning. Heath, top of the morning to you, Cap. I'd tip my hat if I didn't have my headphones. John Steps, any thoughts on resupply cap? Yields on stables are nice. Listen, resupply is facilitating the expansion of CRV USD supply. What more do you need to know? Investing needs to be the hardest thing anyone does. You should look for every reason in the world to not invest, which means that once you do, you own something that's meaningful. And it's a very concentrated portfolio built over time. So, what does that mean? I don't know. Resupply is a very interesting protocol with regard to everything that I own. It bolsters the entire Curve Federation, strengthens it. So I'm like, all right, great, thank you. Love the protocol. Great purpose for CRV USD and Frax. Have a high opinion of Curve and Frax, as you guys are well aware. So thank you, Resupply, for coming online and folks for building the protocol. Um, yields on stables are nice. Yields on stables will be nice at times. Yields on stables will be lower at times. When yields are higher, there's prosperity. When yields are lower, there's austerity. You make less money, you have less money to spend. You make more money, you have more money to spend. Very, very simple. And I very much look forward to having more money to spend at some point. Shit, it's been less money. Well, it's been pretty cyclical since 22. I have some good data going back a couple of years at this point, and it's pretty interesting. And I look forward to more. I have about 3 years worth of data on monthly, weekly revenues. And I tend to look on things monthly. Um, I look forward heading into 2030. That's what I look forward to, and having a good 7 years worth of data to look back on and to see. That'll tell me all I need to know about one, what I invested in. Was it Did I make good choices? And two, it tell me about the markets and how these markets are and where they're heading. So I look forward to building my own data rather than just looking at you know the data everyone else has access to. Anyhow, Yams in the house. Good morning. Hope you're well, my friend. Imagine hearing from your pops and proud. Well, yeah, my daughters. Maybe it drives them nuts. Maybe it drives. I don't know. My girls drop them off at school every day. I'm proud of you. It's not easy. I understand. It's okay to not like school, but there's people that do, and then there's people that don't do. And I try and teach them these philosophies. They won't understand them at their age, but these are the types of things they'll remember when they're 30 and 40 and be like, "Damn, Pops was really the captain, wasn't he?" I can only hope that's what plays out. Plus, an automated carry trade strategy and DeFi, that's everything. That's what looping is. That's what contango is. That's what everyone played around with on Aave back in the day. Um, I mean, Aave, and for folks that remember Aave when it went to Avalanche, or Aave on Phantom, or what have you, everyone loved to loop a little bit. That's all carry trades. That's all carry trades. Carry trades is literally just credit. Literally, when you swipe a credit card, that's a carry trade. Um, except most people swipe their credit card for consumables. So if you swipe a credit card and you're paying 8% interest, you better invest for 10%, and then you have a 2% carry. So when you swipe a credit card at the supermarket, that's a pretty shitty carry trade. You realize swiping a credit card at a supermarket at an 8% interest rate is a negative 8% carry trade. If you really want the analogy to understand what the hell a carry trade is, it's a negative 8% carry trade. A carry trade, a good carry trade is positive interest rate. So the cost or the return of investing is greater than the cost of borrowing. It's by definition what it is. So your involved do that stuff. No, I do not. I do not do carry trades. I do not use derivatives. I just don't. Have I? Sure. Have I played with Yearn? Have I played with everything imaginable in the crypto space? Which is fascinating for a 40-plus-year-old guy. Have I played with these things? Oh, these fun things, these juicy yields, as the youngsters love to call them. Have I played with that? Of course, I played with all the signal through the noise. And I choose rule number one: own. I own. Very simple rule. I don't. I don't rent. I don't. I don't trade. I own. What do I choose to own? More. I choose to own more things over time. And cyclically, I stop owning things or buying things to own more things. And was rule number two. And then rule number three, the ever popular fuck you, pay me is the most important qualification for what you choose to own. Rule one, two, three. Keep it simple. In life, everyone makes things way more complicated than they are, way more complicated than they need to be. The art of life is keeping things simple because that allows people to persist and continue to exist and engage with markets. Keep things simple. Okay? Don't make things complicated. Seek the signal through the noise. And if you can't find the signal, hold off on listening to too much noise. Focus on, you got to first be able to see the signal, and then you're like, all right, this is just noise. Because once you can differentiate, then you find your serenity. And if you need to, Google the serenity pair, ladies and gentlemen, because the wisdom to know the difference is the capacity to differentiate signal from noise. Hope that helps. Fugu in the house. Pithra. Hey, Cap, what do you think of Abacus? Well, it's a derivative product. I have some, uh, what's the VE33 on Avalanche? I always forget it. Faro. So I have some ABC FAR, just some leftovers. Um, it's a derivative product. So there's 5 products in crypto: foreign exchange, credit, derivatives, liquidity financing, and liability printing. That's it. Everything else is one of these. Everything is a duplicate, a variation, a derivative of a derivative, but literally that is by definition a derivative product, as it's wrapping, a fundamental primitive, a V33 um, governance asset. That was a derivative. From my perspective, I don't engage with derivatives. I engage with foreign exchange, credit. I mean, technically, I'm exposed to derivatives vis-a-vis Curve Federation, but that's another story. It's a product offering. So when if you own, for instance, VE FAR, you are affected by ABC FAR. So the derivative bolsters the the enterprise, so to speak. So hope that helps. That's how I put everything into my framework, and that's what makes most sense to me. Ladies and gentlemen of the crypto space, let's wrap it up for today, Monday, April 14th at 12:57 p.m. I thank you all for joining me today. 187 people around the world made it to the end of the stream and are all now a little bit more rational because of it. It is just Monday. Find your signal through the noise. Keep calm, cool, collected, and I will see you guys and gals later this week. Until then, peace.